Good evening, members. I'm Abhay Aslam. Welcome you in today's webinar on the topic and overview of scheme of double taxation avoidance agreement, that is DTAA. So the silent features to today's webinar are: we will discuss the anatomy of Model Tax Treaty Convention, then we will discuss the kinds of Model Convention of Tax Treaties and the recent developments in the tax treaties policy practices. Then we will discuss the evolvement of BEPS, then the introduction of multilateral instruments, and in the end we will have a question answer session. So this is an interactive webinar, so I request all the viewers, if you have any queries, so you can write it down in the comment box, and in the end our speaker will answer your queries. So we are very honored to have CA Parul Jolly ji as a guest speaker. And Parul ji is a chartered accountant qualified in 2004, and she is a partner with SCV and Company LLP. She is also a company secretary 2001 batch and has obtained law degree from Delhi University. She has completed a certificate course in international taxation conducted by ICI. She has been member of International Tax Committee of ICI in past and special invitee to International Tax Committee of NIRC. Presently, she is a treasurer of Delhi chapter of Chamber of Tax Consultants, and she also has a vast experience in handling assessment proceedings under the Income Tax Act. She specializes in the area of international taxation and transfer pricing across various industries. I welcome you, ma'am, and we are very honored to have CA Asim Chawla ji as session chairman. Asim ji is a practice leader at ASC Legal, Solicitors and Advocates in New Delhi. Asim ji is a member of Bar Council of India and fellow chartered accountant, and a certificate holder of comparative tax administrative from Howard Kennedy School. He is a candidate for the prestigious Venia certificate in double tax treaties under the auspices of WU Venia University of Economics and Business, Austria. He is a certificate holder from National Insurance Academy, Pune, for the participation in the orientation program for the independent directors of general insurance companies in February 2020. I welcome you, Asim sir.
Yeah, very quickly. Thank you, Mavia. Parul, great to have with you, and I'm sure you're ably assisted by good offices of your eminent accountancy firm. I mean, it's a preeminent name in the country, and very delighted to have you personally, and appreciate all your diligence, all along. And you've done well for yourselves in the field of taxation and in international taxation. Very quickly. And my apologies if you find delegates in wearing the lawyer civil dress. It's just that my matters are ongoing in the other uh, room. The virtual hearings. That's the good or the not so good part of it. So, what is this whole? I mean, just to set the stage for it, and Parul has done a lot of hard work. Their slides are very good. She's also looked at the impact of multilateral instrument on the tax treaties and the aids to interpretation, formulation of tax treaties and availing tax treaties. Now, do tax treaties restrict the right of taxation between the source state and the resident state? No, they only allocate. Two states sit on a इन सिंपलिस्टिक मैनर आराम से कहें आसान भाषा में कहें तो अक्रॉस द टेबल बैठे और जहां जहां ऐसा एक पोटेंशियल सिचुएशन आता है कि आप टैक्स कर सकते हैं और मैं भी कर सकता हूं where two states both believe that they have a right under their domestic tax law to tax a subject, then in that situation, to obviate or alleviate double taxation, you have under the world of tax treaties, under the framework of international law, one of the facets of international law is international taxation, and within international taxation now you're looking at the whole conspicuous of tax treaties. So you have a source state जहाँ income जहाँ जहाँ income उत्पन्न हुई, from where the state in which the income, let's say for ease of nomenclature, has arisen, and the state of resident where the resident is. So I am a resident of India. Income has arisen in another country, and as per the laws of the country, that income is taxed. Now there are few countries which follow territorial system of taxation. There are few countries which follow global system of taxation. Quintessentially, मिसाल के तौर पे Singapore says whatever you earn from Singapore, we will only tax that. I'm just giving an oversimplified example. Don't treat it as an opinion, right? Hong Kong also says this कि आपने साहब जो यहाँ कमाया We will tax this. Now, I may be earning income being a resident of Singapore from other places also. Singapore says that we are not going to ordinarily tax it unless and until you bring it and all those rules. India, like US, says if you are a resident of our country and if you are an ordinary resident, looking at the scope 4, 5, residential 6, 9, wherever, whatever accrued, deemed to accrued, received, whatever, we principally you are going to pay taxes because you are resident of my country. Now, the other state may also have some forms of taxation, maybe an upfront withholding tax, or they may also like to tax in accordance with laws of that state. So, obviate the double taxation, countries will sit across the table. The way you contractually negotiate, you also contractually negotiate tax treaty, मांड वाली होगी, कुछ give and take होगा. And these tax treaties are framed out of consideration other than taxation. I mean, Azadi Bachao Andolan 263 ITR 706 clearly brings to bear the famous decision of Supreme Court कि साहब टैक्स ट्रीटीज जो है इसको कार्यान्वित करने के कई कारण हो सकते हैं. जियोपॉलिटिकल रीजंस हो सकते हैं, स्ट्रेटेजिक अलायंसेस हो सकते हैं, एंड सिचुएशंस में चेंज ओवर अ पीरियड ऑफ टाइम. So there are bilateral peculiarities when tax treaties are negotiated, and there are several examples of such peculiarities. Now, the importance of the OECD and the UN Model Convention is that these are two institutions which, over a period of time, have generated so much of literature that they have assumed the power of a soft law. If you look at the recent decision of excellence, that royalty judgment decision given by the great jurist Justice Nariman, he said that OECD commentaries have a great credence value, and similarly the UN commentaries, especially for countries which are part of the UN framework, much like India, which is not part of OECD, they are equally important. So when you look at a tax treaty, please look at these commentaries. Of course, Parul will take you through not only the world of tax treaties, but the MLI which is knocking onto the door, or not only has knocked on the door, but has entered in and sits across with the tax treaty. Now you have a package. Treaty, its interpretation, commentary, MLI impact, if any, how to read MLI. In some cases, you will find synthesized text also, where two states have agreed on either a common synthesized text or their two versions of synthesized text. So all these are great evolvement in the school and in the philosophy of international taxation. At present, I find it's on an exhilarating overdrive. Changes are happening thick and fast. Things like same income being taxed twice could lead to economic double taxation. Income is source country में भी tax हुई, residence country में भी tax हुई, same income दोबारा tax हो गई. उसको आप economic double taxation कहेंगे. If the same income is being taxed in two different person hands, shareholder के हाथ में भी हुआ, company के हाथ में भी हुआ, तो jurisdictional double taxation हो जाएगा. So, and it's not that the world of tax treaties is very new. I mean, tax treaties go back ages, and therefore what is important is the allocation of taxing rights amongst the two countries. So remember, tax treaties don't restrict, they only allocate, because the intention is income should not be doubly taxed. The entire genesis of MLI is to avoid double non-taxation, कि ऐसा ना हो कि यहाँ भी ना हो और वहाँ भी ना हो और आप टैक्स ट्रीटी के मजे लेते रहे. ऐसी इंटेंशन नहीं है. It's a different matter that the other country may not have a tax in their state, or tax is not promulgated. जैसे UAE या Middle East है. There is a taxation framework, but the rates of tax in certain situations are zero. ऐसा नहीं है कि UAE में कोई इनकम टैक्स नहीं होती. शिपिंग इनकम, बाकी बिजनेसेस टैक्स होते हैं, right? But the tax rate is pegged at zero, or it's a low tax situation. So some countries are low tax jurisdictions, some countries are tax friendly jurisdictions, some countries may be viewed as havens also because there is no taxation. I mean, you hear a lot of stuff in and around those Paradise, Panama leaks and those HSBC, that how these situations have arisen. So All these aspects Parul is going to take up. I am more than happy to see Parul here, and I'm grateful to not only Parul but to the principals of SCV who have constantly encouraged their team. And there's a great knowledge incubation which happens in this great firm. And Parul is just an epitome of how well she has blossomed over the years. Parul, over to you.
Thank you, sir. Thank you so much. I will just share my screen first.
Yeah, so I'll stop the cam. It'll be easy for everybody.
So, is my screen visible to all?
Yes, ma'am. It is visible.
Okay, great. So, good evening, everyone. The topic for today's evening under this webathon series is Basics of DTAA. Before I start, I would like to thank uh, Asim sir for setting the tone, for giving me this opportunity to share the knowledge on this topic with the fellow professionals. And it's actually an honor and pleasure for me to share a dais with Asim sir, who has always been an inspiration and guide for us. So, thank you, sir. So though these 2 hours are too short to discuss even basics of DTA, I have tried to cover the maximum, and if time permits, I'll also touch upon the MLI provisions. The topics I will be covering are introduction to text treaties, aids to interpretation of treaties, formulation of text treaties, then I'll be discussing the structure of tax treaties and how the tax treaty benefits are availed as per our domestic law, and then overview of MLI. So first of all, introduction to tax treaties. Why these treaties were made, and why over the time these treaties have gained so much importance, and learning around it become crucial from tax point of view. In simple terms, what is a treaty? Treaty is basically to address the tax concerns with regard to any international transaction. So with times constantly changing, businesses becoming complex, particularly in the era of technology and digitization, there are so much cross-border transactions and global trade. So all countries with an endeavor to maximize their tax collection are grappling with international tax issues. So one of the most significant results of this globalization is the noticeable impact of one's country's domestic policies on the economy of other country. If there is a domestic law policy in India, so and maybe a change in the domestic law, so due to this globalization, the economy of other country also gets impacted, and that is why there is a need for assessing the tax regime of various countries, and as a and that is why the consequence of taxation has become a very very important consideration while analyzing any trade and investment decision. So why a tax treaty and how it removes tax barriers? As Asim sir mentioned, other than the tax consideration and as discussed, as observed in Azadi Bachao Andolan, there are other economic and uh, various factors uh, which are also a factor when a tax treaty is formed. But as far as the taxation aspect is concerned, a treaty eliminates double taxation. We'll discuss in detail with example how double taxation happens and how a treaty addresses the situation of double taxation. It provides clarity of fiscal situation of a taxpayer. It also contains provision as to the exchange of information to combat tax avoidance and tax evasion. Tax treaties provide certainty of tax treatment. We'll discuss in detail about this also, and it prevent tax discrimination. So first, it provides mechanism of taxation which is common for everyone who is resident of any of the two jurisdiction uh, between which there is a treaty. And it also contains clauses of non-discrimination, like non-discrimination clause and MFN clause. And if we see the terminology given in Oxford Companion, Vienna Convention, and OECD. So, so I have purposefully taken these definition from the Oxford, Vienna, and physical, so that we understand what exactly a treaty means. So, as per Oxford Companion, a treaty is an international agreement, normally in written form, passing under various titles, concluded between two or more states on subject of international law, intended to create rights and obligation between them, and governed by international law. Vienna Convention also explains a treaty in the similar manner as an international agreement concluded between states in written form and governed by international law, whether embodied in a single instrument or in two or more related instruments, and whatever is its particular designation. OECD defines double taxation. It defines double taxation as the imposition of comparable taxes in two or more states on the same taxpayer in respect of the same subject matter and for identical period. So, if we combine these definitions, in simple terms, a tax treaty is an agreement between countries that covers all tax aspect of cross-border transaction. So, purpose is to regulate matters concerning tax. And if we see the technical definition, it is a agreement between countries. So tax treaty is agreement between two countries. So it creates rights and obligation for those two jurisdiction only, and not for any third party with respect to taxes on income and on capital, wherein the countries agree to be restricted from taxing. As Asim sir said, the purpose of treaty is not restriction. So when we say restriction, it's not in a sense that they restrict a country from imposing a tax. What it does, that they forego or limit their right of tax by either allocating exclusive right of tax to one state or by sharing the taxing rights. So restriction is not in a negative sense that restricting somebody from imposing the taxation. It is more in the allocation sense. The other thing which the countries agrees to is to eliminate double taxation. So double taxation could be of two types: theoretical double taxation, economic double taxation, and I have an example to explain this in the next slide. So tax treaty could be limited, it could be comprehensive. When we say limited tax treaty, it means it deals with the specific source of income and certain issues for taxability of those income. And when we say comprehensive tax treaty, it means it contains all sources of income. And India has almost 94 comprehensive DTAs and 8 limited DTAs. The treaties could be bilateral or multilateral. So till now we had this bilateral treaty concept. There were treaties between India and other countries. Now we have this multilateral uh, concept wherein there is a document which is applicable for more than two countries. So what is a juridical and economic double taxation? A juridical double taxation is when two or more states levy taxes on same income for identical period. So the income is same, stream of income is same, the person who is taxed is same, the period in which he is taxed is same, but he is taxed in two separate jurisdictions. So that is juridical double taxation. If we see an example, US company is a resident of USA receives royalty income from an Indian company. So US company being resident of USA liable to tax in USA on that income, and India being the source state has given right to tax that income under section 9, and person while paying that income to US company would deduct tax at source. So that is how that income will be taxed in US also and in India also. So this is called juridical double taxation. As far as economic double taxation is concerned, the same economic stream of income is taxed in two or more states, but in the hands of different taxpayer. So the example could be the rewriting of profits for transaction between AEs. We can understand it with the help of this example. an Indian company pays commission of rupees 100 to a company in USA. So that company who is a resident of USA will pay taxes on that 100 rupees of income. Now, there is a transfer pricing assessment on the Indian company, and the ALP determined for this commission payment is 80. So 20 gets taxed in the hands of Indian company. Now, rupees 20 gets taxed in the hands of US company in USA, and Indian company also get taxed on that 20 in India. So same stream of income, but get taxed in the hands of two separate persons. This is economic double taxation. So tax treaties largely prevent or mitigate juridical double taxation, and we'll see it later. As we know, in India, taxability is governed by Income Tax Act. Similarly, in every jurisdiction, the domestic law of that country governs taxability. So applicability of treaty is conditional to the applicability of the act, because treaty is not a charging provision. Treaties do not impose tax. The tax is imposed under the domestic law. In India, we have Section 5, Section 9, which defines the scope of income, the scope of taxability, and then for going to treaty provisions, the legal sanctity is through Section 90. Section 90 allows the taxpayer to refer a treaty in case there is a double taxation and maybe a transaction which involves two jurisdiction, and then it gives a right, an option to the assessee to use the provision which is more beneficial to the assessee. So in our act, we have section 90 for giving relief under the treaty, which is a bilateral relief. And under section 91, we have unilateral relief, wherein there is no agreement with the country. However, if there is an income which gets doubly taxed, section 91 gives us the relief to uh, to avoid tax in two different jurisdictions. Now, what is aids to interpretation of treaties? So it simply means the literature which is available to understand the language and also the intent of the treaties. These are generally referred to interpret words on common intent of parties, basically to make the meaning more clear. So we have internationally recognized aids available. The first one is protocols. So protocols are basically supplementary document to treaty. It's a part of treaty which is concluded based on the negotiation. Protocols have binding force which is equivalent to DTAs, and we can have any as many protocols as we want in any DTA at the time of signing or after conclusion of DTA as well. So protocols helps in understanding the provision. It provides clarity to the provisions which are there in the treaty. Then we come to Vienna Convention. So earlier interpretation of international law was based on customary principles. Later, these principles were codified. So, Vienna Convention is a declaration of those customary law. It was signed on May 23rd, 1969. International Court of Justice also recognized Vienna Convention because it gives a neutral interpretation of important principles of treaties, which is independent of domestic law. So we take help of Vienna Convention in case of doubt. In fact, the courts take a reference from Vienna Convention to understand the intent or maybe sometimes terminology of the treaty. So later, some countries goes a step further, and in conjunction of Vienna Convention, they rely on supplementary means of interpretation like OECD model commentary, UN model commentary, and US technical explanation. So, what is OECD model commentary? What is UN model commentary? And what is the difference? We have covered it a little later. So there are other sources which also helps in interpretation of treaties, the multilateral instruments, mutual agreement procedures. There are technical explanations to the treaties. We have international decisions. Sometimes we refer international decision to understand a term or a purpose of a treaty. And then the practices of the tax authorities, practical approach of the tax authorities of the two country also aids to interpretation of treaty. So we will spend some time on this model commentary before we move further. So these model conventions are basically, as we discussed, aids in negotiation of tax treaties to make the treaties uniform and in helps in interpretation of treaties. So we have two main models, which is OECD model and UN model. OECD is basically Organization for Economic Cooperation and Development, which was established in 1961 with developed countries as its member. So it's a basically treaties between the developed countries. The OECD model advocates residence principle, so it gives more right of taxation to resident country. India is not a member of OECD, but courts do refer commentary of OECD to understand the term or the intent of the treaty. It's not binding on India, but it has a purposive value while interpreting the law. The other model is UN model, which is basically treaties between developed and lesser developed countries or maybe developing countries. This model was drafted in 1980. So it is basically compromise between source principle and residency principle, though it gives more weightage to the source principle. That is the income. Uh, it advocates the principle that the income should be taxed where it arises, and most of the India's treaties are based on this model. Then how a treaty is formed? How does a treaty is formulated? In most of the countries, draft agreements are placed before parliament for approval. But in India, this authority to conclude a treaty is delegated to central government under Section 90. And the competent authorities, Joint Secretary, Foreign Tax and Research Division CBDT. So the journey of a treaty being concluded, first the negotiations takes place as Seem sir mentioned in the beginning. आमने सामने बैठे दो कंट्रीज के पर उन्होंने negotiate किया, then they draft articles, then the treaties are signed, then the ratification happens, and then there is a notification which is being issued, and then only the treaty is applicable. So there is a date of convention when this is signed, then the process of ratification, which is the ratification by the executive consent in each contracting state as per the domestic law, that is done. Then there is exchange of notes between these two contracting state. It's mentioned when this treaty will enter into force and there is an effective date. So post the date of entry into force, there's a date mentioned in the treaty in Article 30. So this concept of entry into force and entry into effect is more relevant for MLI provisions. I have covered it later in my slides because as far as DTAs are concerned, so these DTAs are there since ages, so they are already into effect. But for MLI, whether a particular treaty will be read along with MLI or no depends upon whether entry into effect is there or no. So how to compute it? Why is it relevant? We'll cover a little later. Then termination of convention. DTAs generally remain in force until they are terminated. Some DTAs give a period of lock-in after which it can only be terminated. Like India US GTA has a lock-in period of 5 years, and these GTAs are terminated once a notice is exchanged through diplomatic channels between the countries. Treaty protocols we have already discussed. Other than the treaties, there are certain MOUs which are also there in some of the treaties, like India US treaty, wherein there is an MOU as to the interpretation of the term fee for included services. So these are also part of DTAs. Structure of a treaty. So more or less every model convention and also every treaty is structured in the similar fashion. Article 1 and 2 generally define scope and the taxes covered. Article 3, 4, 5 are generally the definition provision. 6, 7, 8 up to 20, there are substantive provisions which allocate the rights between the countries. There are certain miscellaneous provisions like non discrimination, termination of entry into force. So these are there. And we have other articles like 23 and 25, which are more on elimination of double taxation. There are certain anti avoidance provisions also, like Article 9 and Article 26. Then, as we discussed, protocols and MOUs are also part of the structure of treaties. So let's just understand what exactly these articles of treaties state. So first is general scope. It defines to whom the DTA will apply. So generally, the scope is similar in all the treaties, which states that DTA applies to person who are resident of one or both of the contracting state. So person has to be resident of one or both of the contracting state, and once it's determined that he is a resident, then the treaty would apply to that person. But there are few exceptions wherein the article related to general scope is being extended to give a certain exception, like India USA treaty. First, it states that India US DTA, in the India US DTA, states that contracting state may tax its citizen as if the convention has not come into effect. So, what it says is कि any of the two countries can tax its citizen as if this convention is not there without reading to the convention. So, that right is reserved. Further, it states that DTA shall not restrict any exemption, exclusion, deduction, credit as per the laws of contracting state. So, this is basically a non discrimination clause. It says that whatever benefits is available to the national of a particular state, by applying the treaty, those exemptions, deductions, credit shall not be restricted. So I've given an example to understand this concept. A citizen of America who is a non-resident. So this example is based on a case when this deduction 80 which is in respect of export of software, was there in the law. So there was a citizen who was a non-resident, and he was exporting software from a permanent establishment in India, and he claimed deduction under Section 80 It was questioned that profits of a PE has to be taxed in accordance with the DTA provision. Article 7 of the DTA provides the mechanism to tax the profits of permanent establishment. And Section 80 HHE is only applicable to domestic company. However, it was decided that as per India USA DTA, taxation of a P of a USA resident shall not be less favorable than taxation of resident enterprise carrying on same activity. So accordingly, that deduction was granted to that particular assessee. So this is basically a citus-based non-discrimination. Then Article 2 basically gives what are the taxes covered: taxes on income and capital. So in Indian treaties, wealth tax and was also included, though the tax has now been abolished. It also cover income tax, surcharge, and surtax. Surtax is also not there now. As far as the other jurisdiction is concerned, tax covered vary with each DTA. Like, for example, India UK DTA covers petroleum revenue tax also. India German DTA covers German trade tax. India US DTA covers US federal tax as well. So it varies from each DTA. It further says that treaties will also apply to identical or similar tax which are imposed after the date of signature of convention, in addition to or in place of the existing taxes. So, for example, in India in 2004-5, we have the cess, which is made applicable, which is similar and identical to the income tax. Hence, uh, There are jurisprudence available concluding that education cess comes under this category of identical or substantially similar tax and gets covered in DTA. There are certain exceptions. Indirect taxes are generally not covered. Social security charges, any monetary fines and penalties, any interest for late payment, these are not regarded as taxes for treaty purposes. Article 3. It's a general definitions. So definition of person, individual, company, national, business, contracting state, other contracting states. So Article 3 defines various definitions, terms which are used in the DTA. So what if a term is not defined in DTA? If a term is not defined in DTA, then law says that one may refer to the definition given in the domestic law. So, for our purposes, if a term is not defined in the DTA, we may resort to Income Tax Act. And what if both have different meaning, and which may lead to the double taxation and double non-taxation? Then the international law says that if there are two different meanings possible and which would result in double taxation or non-taxation, one has to go to competent authority under MAP to understand the meaning of that taxation. However, if that term is not defined either in the Act or in treaty, then in the context of India, Section 90, subsection 3, it says that the meaning of that term, if notified by the government in official gazette, then that definition has to be referred. And explanation 3 to section 90 subsection 3 provides that the term defined in official gazette shall be deemed to have effect from date on which DTA is signed. So when we say we'll have to refer to the definition of Income Tax Act or maybe domestic law of any country, if that term is not defined under DTA, what does that mean? Does that mean that we have to refer the meaning of the term as was applicable when the DTA was signed or when this uh, provision has to be made applicable? So OECD support that if a term is not defined at the time of signing of the DTA, but is defined at the time of application of a particular provision, one may resort to that definition. This is called ambulatory approach. And India's uh, treaties with the countries like Armenia, Hungary, Kazakhstan, South Africa, it has ambulatory approach of understanding the taking the meaning of any term. However, this is in contradiction of what Section 90, subsection 3 explanation says. It says that the term defined in official gazette shall be deemed to have effect from date on which DTA is signed. This is called static approach. So to that extent, there is this contradiction and there is jurisprudence on this particular issue. In any case, we'll move further. Suppose there is no notification available, then the court may resort to any non tax law to understand the meaning of a term. The classic example is the definition of copyright. It is neither defined in the treaties nor in the act. There is no notification to that extent. So, in the recent decision of engineering, uh, the court has referred the definition of Copyright Act to understand the term copyright. And if no definition is available, then one has to go to competent authority, that is MAP, to understand the definition or any term. So we'll move to Article 4, which is residence. Am I making sense? Any questions till now? Or should I continue? Anyways. So let's move to Article 4 residence. So Article Scope of convention states that treaty will be applicable to the resident of one of the jurisdictions. So that is why it's very important to understand who is a resident. So Article 4 lays down criteria for determining residence of a person. Generally, in all the articles, the definition of the resident of one of the state means any person who, under the laws of that state, is liable to tax therein by reason of his domicile, residence, place of management, or any other criteria of a similar nature. So, when we say liable to tax, the courts have interpreted that should have been an income tax liability on such person under the law of that country and shall include a person who was subsequently exempted. So, as Asim sir gave an example of UAE, so there is an income tax law which is applicable to the residents of UAE, but because of some like there is the tax rate is kept zero or the income is exempt. But those the person who is resident of UAE are liable to tax there. So the concept of resident of a contracting state, this concept is required to solve the cases where double taxation arises in consequence of double residence, and also in solving the cases where double taxation arises as a consequence of taxation in the state of residence and in the state of source. So one has to understand what is residence if we have to solve the cases of double residency or double taxation. For example, an individual has a permanent home or he is a citizen of, say, country A. So, being a citizen or having a permanent home in country A imposes tax on worldwide income. Now, suppose he has stayed for more than 6 months in country B, and according to the legislation of country B, he is liable to tax in country B as well. He becomes resident of country B. Now, there is a situation a person is resident of both the countries. So, Article 4 provides solution to this issue of double residency also. So, for individual, what the law says that if a person becomes resident of one or more jurisdiction, then we'll have to check the permanent home test where the permanent home is available. So, if he has a permanent home available in, say, country A, he is considered resident of country A for treaty purposes. Suppose he has permanent home in both the countries. Then we'll see where the center of vital interest lies. So when we say center of vital interest lies, where his personal and economic interest lies. So so to test this particular criteria, it's basically question of fact. We'll have to see where is his family, where are social relations, where is his occupation, where is his place of business, etc. But supposingly, we cannot determine its place of vital interest, and suppose he has permanent home not available in any of the two jurisdiction, then we'll have to see the habitual abode test. Habitual abode test means कहाँ वो generally रहता है. So we'll see the number of days stay in both the jurisdiction. So it will include even the stay in the hotel and short stays. We'll aggregate that and we'll see where that person generally resides. Suppose he resides, both the countries are his habitual abode. Yeah, or maybe none of the country is the habitual abode. Then we'll see the nationalities test, and he will be considered resident of the state of which he is a national. And if he is national of neither or both of the countries, then one has to resort to MAP, which is the competent authority to determine the residential status. So this is for individuals. For non-individuals, we have this concept of place of effective management. Now we have this concept in our domestic law also, but it's an internationally accepted concept. OECD commentary, though in case of a dual residency situation of a person who is not an individual, OECD commentary says that In such cases, the residency shall be determined by competent authorities of two countries by way of mutual agreement. UN commentary, in the commentary itself says that if a non-individual becomes resident of both jurisdiction, then we'll see where the place of effective management lies, and wherever the place of effective management lies, that person will be considered resident of that particular jurisdiction. The factors to determine place of effective management is similar in UN commentary, in, in Indian Income Tax Act, the circular issued by the CBDT, and it's also similar for competent authorities. They also consider the factors like where the board of director meetings are held, where the day-to-day management senior people take decision, where is headquarters are located, where are accounting records located. So basically, where all the economic and significant decision of the person are taken. So after Article 4, we'll come to Article 5. I'll just touch upon the basics of concept of P because this in itself is a topic which can be discussed and debated over a series of seminars. So I would take a part of it, a basic understanding of permanent establishment. Permanent establishment P, it's considered as an artificial entity which is created for taxing the income of a non-resident from business operations carried out by it in India. Few situations like service P, construction P, the concept of P triggered if a specific threshold of number of days is achieved, and by constituting a P, what Indian revenue authorities gets is the right, or any tax authority gets is the right to tax the income of non-resident attributable to that permanent establishment. So it's a long article. I have taken the OECD model as a basis to explain it. So Article 5.1 is basically the basic rule, that is a fixed base P through which the business of enterprise is carried on. So if a non-resident has a fixed base here through which he is carrying on a business, that is considered as a fixed base P. There are numerous jurisprudence available to understand what is a fixed base, how much duration is considered as fixed base. So uh, we have this Formula One, wherein even the racing tracks are considered fixed base P. So Article 5.1 is the basic provision what is a fixed base P. 5.2 basically gives an example illustrative list of P, like warehouse, branch, office, factory. So Article 5.3 is what we call generally as construction P. So this is P in relation to a project. So if a construction contract, an EPC contract continues for more than a particular period in another country, so a construction PE is said to be constituted, and the profits attributable to that project gets taxed in other jurisdiction. So different model, OECD, UN model have different threshold period. UN model generally, UN model says 6 months period. India's treaties with countries like Switzerland, Sweden, Spain, the threshold period is 6 months. OECD talks about a 12 months period. The treaty, like Russia, has a higher threshold for constituting construction P, and then the the threshold can be negotiated between the countries. OECD and UN model just give a, a base for basically this criteria of having a threshold for constituting a construction P, but the days can be negotiated between the countries. So, for example, in India-US treaty, we have a 120 days threshold. With UAE, we have a 9 months threshold. So, if you have we have different threshold and different treaties. But if a construction activity is carried on in another jurisdiction for a reasonable period of time, that is a construction PE. Then we have uh, para 4 of Article 5, which gives list of exclusions, what is not included in a PE, which generally contains the activities like storage, purchase, preparatory and auxiliary activities. So we have one more type of PE which is not there in OECD model, and hence not is not there in this particular table. But in UN model, we have this service PE concept, and more so because UN model advocates source rule, and the concept of service PE is also based on source rule. That is why we have the service PE clause, which basically means if a particular uh, the employee or the other personnel of an enterprise in one jurisdiction furnishes services in another jurisdiction, and that furnishing of services exceeds a threshold which is given in the treaty, then there is an exposure to service PE. So we have treaties wherein there is no service PE clause like France, Denmark, but we have treaties with US, Finland, Singapore, and there is a service PE clause. Other than that, we have dependent agent PE, wherein a person acts on behalf of a person who is of another jurisdiction and uh, fulfill certain conditions. There is an exposure of dependent agent PE. Article 5.7 OECD model commentary talks about a subsidiary generally. So what it says is subsidiary per se is not considered as a P. However, if it fulfills the other factors criteria of other conditions of becoming a P, then it is considered as a permanent establishment. So what if a particular enterprise or a particular entity is considered to be PE of a company who is a resident of another jurisdiction? Then OECD model says that the profits that are attributable to that permanent establishment that gets taxed in the jurisdiction where there is a permanent establishment. However, UN model has this concept of force of attraction, which states that not only the profits which are attributable to that permanent establishment, any other sale in that other state of goods or merchandise of the same or similar nature as those sold through that permanent establishment, then the profits attributable to that activity will also get taxed. It further says that if there is any other business activity which is carried on in that other state of the same or similar kind as those effect through that permanent establishment, the profits from that activity also gets taxed in the other jurisdiction. So force of I've given an example of to understand this force of attraction rule. So for example, A Limited has a branch which is considered as a P in another jurisdiction. It's export garments through that P, and it also has direct sale of garments with various customers. So we have this force of attraction rule in India USA treaty, as a result of which the profit of Indian branch will not only include the profit which is earned through own sales, it will also include the profits earned by the foreign enterprise, the USA entity, from the direct sales to customers in India. So this is force of attraction. So force of attraction rules apply based on the language of the force of attraction rule given in the treaty. So one has to be very particular while reading a particular treaty and applying this force of attraction rule. So this was about the main business income. Then we have articles which relates to the passive income like interest, dividend, royalty, FTS. So as we understand that the chargeability of income is governed by section 9(5) of the Income Tax Act. The provisions of taxability given in the Indian Income Tax Act are more or less similar in case of interest, royalty for all passive income. So I have taken one example of section 915 which relates to interest income. So basically if there is a non-resident who is deriving income from any company who is resident in India, so the payment of interest to a foreign enterprise who is a non-resident, if we see section 5, the income of a non-resident is taxed in India if it is received in India, deemed to be received in India, accrue in India, deemed to accrue in India. And what is deemed to accrue arise in India is defined in section 9, which says that interest income is deemed to accrue or arise in India if it is payable by the government. So if Indian government pays interest to any non-resident, it is taxable in India. Similarly, if it is payable by a resident, unless it is payable in respect of any debt incurred or money is borrowed and used for the purpose of any business or profession carried by such resident outside India, or for the purpose of making or earning any income from any source outside India, then only it is not taxable. Otherwise, it is taxable in India. If interest is paid by a non-resident, then there can be it can be deemed to accrue arise in India if it is payable in respect of a debt incurred or money is borrowed and used for the purpose of a business which is carried on by such non-resident in India. So, interest income of a non-resident, such cases gets taxed in India, and the person who is recipient of that income, the that income is also taxed in the country of resident. So there is a double taxation. So how this double taxation is taken care of in the by way of DTA. Article 11 of the convention says that interest income may be taxed in the state of residence. So primary right is given to the state of residence. Then it says it may also be taxed in the source state, but the tax rate is generally restricted. It's 10% in few treaties and 15% in few treaties. So primary right is given to the state of residence, and there is then a restrictive right which is being given to source state also. And since the income is taxed in both the state, there is a mechanism of availing exemption or credit of the taxes paid in the country of source. So whatever is paid in the country of source, this is 10%, 15%. The person can get a credit of those taxes in the country of residence. So that is how this double taxation problem is resolved by resorting to the treaty. This is regarding Article 11, which is the trust income. Then we have Article 12, royalty. So, general definition of royalty is use of or transfer of all or any rights, including granting of any license, in patent, invention, model, design, secret formula, processes or trademark or similar property, copyright, literary, artistic or scientific work, including films or videotapes, but excludes consideration for sale, distribution, and exhibition of cinematographic films. It also includes imparting of any information concerning working of or use of patent, model, design, secret formula, process, trademark, or similar property, any technical, industrial, commercial, or scientific knowledge, experience, or skill. It also includes right to use any industrial, commercial, or scientific equipment, a patent, invention, model, design, secret formula, process, trademark, or similar properties. So there are so many terms used in the definition of royalties. There is a lot of litigation surrounding royalty income, especially income from a software. So we'll not be taking up that controversy, and will be focusing how if a particular stream of income is considered as royalty, then how its treatment is done while taxing in different jurisdictions. So, like interest income, Section 9 also gives right to India. to tax the income of non-resident if certain specific conditions are specified, similar to that of what we explained in the case of interest. If a resident is making payment to a non-resident and it does not relate to any business or source of income which that non-resident has outside India, or if a non-resident is making payment uh, to another non-resident of royalty which pertains to any business which is there in India. So India gets the right to tax, and obviously the country in which that particular non-resident is resident also has the right to tax. So, similarly, as of interest income, the primary right of taxation is given to state of residence, and there is restricted right which is given to the state of source. Uh, Again, 5%, 10%, 15%, different treaties, different negotiation, different rates. So one has to see the rate given in the treaty, and since surcharge and education cess are considered part of the taxes under the treaty, so whatever rate is given is in the treaty is inclusive of is considered inclusive of any surcharges. So if we compare the rate of royalty and FTS, so rate given in section 115A in the Income Tax Act is 10%. So we if the income gets taxed in income tax, the rate would be 10% plus surcharge plus cess. But if we one resort to the double taxation avoidance agreement, the rate given in the treaty will be all inclusive. So if the rate given in the treaty is again 10%, one can claim benefit of the treaty and pay taxes on 10% and not 10 plus surcharge plus cess. Then we have this article, fee for technical service. So basically, income tax act also defines and taxes fee for technical services for residents. We have the definition given under section 917. So basically, it's a payment to any person in consideration of managerial, consultancy, technical services. What is a managerial services? Basically, it is involves controlling, directing, or administrating the business. Technical services, it's the provision of services which require special skills or knowledge related to a technical field. Consultancy services, so basically, it's a provision of advice by someone such as professional who has special qualification which permits him to give that particular consultancy. So if a non-resident receives an income by way of fee for technical services. The same is taxed, is deemed accrue arise in India if the conditions of Section 917 in the Income Tax Act are fulfilled. It is also taxed in the foreign jurisdiction, being the country or state of residence. So the article in the treaty provides solution for that. So again, primary right given to the state of residence and a restrictive right to the state source, country of source. So there is one unique concept of make available which is given in many DTAs, which further restricts the taxability of fee for technical services in case of a cross-border transaction. What the definition of fee for included services or the technical services uh, in the DTA states that it's payment of any kind to any person in consideration for the rendering of any technical or consultancy services if such services are ancillary or subsidiary to application and enjoyment of any right, or make available technical knowledge, experience, skill, know-how, or processes, or consist of the development and transfer of a technical plan or technical design. So, what is this make available concept? By make available, it means that the person acquiring the services, the person who is getting the services, is unable to apply the technology. So, mere requirement of technical input by a person providing services does not necessarily mean that the technical knowledge is made available. But if, for example, I do an audit or give consultancy to a person in another jurisdiction, but that does not enable that person to have that knowledge of providing consultancy or doing audit, So this is not make available. Make available is something when I provide a service to somebody, and later he, suppose I give a training or a technology developed by me to somebody which he can use, and he can provide similar services in future to the clients without coming back to me, and he is unable to basically apply that technology. That is called make available. So this concept is there in India, UK, US, Singapore treaty, wherein one can resort to treaty definition, and that's how there is a restriction as to the taxability of that income as per the treaty provisions. Then we have article related to capital gains. So this term capital gains is neither as such defined in the Act nor under the treaty. But in general parlance, we understand that it's profits and gains arising from transfer of a capital asset, maybe movable or immovable. From capital gains perspective, gains from alienation of asset, especially movable asset, are generally taxable in the country of residence. However, for some assets, country of source is also given full, partial, or no right. That we'll see later. And certain assets are also taxed based on their uh, situs, especially the immovable assets. So, UN and OECD model convention generally gives the allocation of rights as given in this particular table. So, para 1 deals with the alienation of immovable property. So if I transfer an immovable property, gain from immovable properties, the right to tax is given to the state where the property is situated. So this is situs based taxation. Then generally paragraph 2 deals when there is a transfer of movable property which is part of a business property of a permanent establishment or pertains to a fixed base wherein an independent personal services are rendered and there is a threshold of fixed base which being achieved. So in that case, there is a transfer, it gets taxed in the state where the permanent establishment or the fixed base is situated. Then paragraph 3 generally deals with the transfer of ships in international traffic or aircraft in international traffic or any movable property which is related to operations of such ships or aircraft, and the right to tax is given to the country of residence. General principle. Para 4, which is there in few treaties like India Switzerland Treaty, that the gain from alienation of shares of a company resident in the source state deriving value mainly from immovable property in another country. So we are selling the shares, and the shares derive value from the immovable property which is situated in another jurisdiction. So the taxing right is given to that country. Then we have this gains and alienation of from sale of shares of a company which is resident in source country. So, in case there is a gain from sale of shares of a company which is resident in source country, the taxability of same is not given in OECD model. So, in OECD model, any transfer other than those mentioned in paragraph 1 to 4, then the country of residence is given the right to tax. However, in UN model, we have this article wherein there is a gain from sale of shares other than what is referred in para 4, then taxability, that the right to tax is given to state of source. And if there is alienation of property other than what is given in paragraph 1 to 4 and also the shares, then the rest taxing right is given to country of residence. So earlier we have this Mauritius and Singapore treaty wherein the sale of shares of a company, this article was not there, and the country of residence was given the right to tax. These treaties are recently modified to include the provisions with regard to sale of shares of a company which is resident in another jurisdiction, and the taxing rights are being given to that particular jurisdiction. So this is basically the summary of source rule, that the for immovable property, the taxing rights are shared and allocated to the state where the property is situated. For business or profession, the permanent establishment given the state wherein there is a permanent establishment is given the right to tax. Dividend interest, royalty, FDS, though the primary right is with the resident state, but so state is also given restricted right to tax these incomes. Similarly, other income is generally taxed in the state of residence. So, how to avail the treaty benefit? Simple. First of all, we'll see if we have to apply. Suppose we have to make a payment to a non resident. First, we'll see whether that particular transaction is chargeable or not as per our domestic law. Because, as we discussed, DTAA do not impose tax, they only allocate the right to tax. So, first we look at Income Tax Act, we look at Section 5, Section 9, and if there is a chargeability under the Act, then we'll go to the particular treaty. Suppose I have a transaction with US, I'll go to US treaty and see first of all Article 1, the scope of convention, that is whether this treaty would be applicable or not. Then we'll see the relevant definition of, especially of resident taxes, what all taxes would be covered, what whether uh, I be considered the resident of any of the two jurisdiction based on the criteria laid down in the definition of resident. And suppose one become resident of both the state, then we'll have to apply that tiebreaker rule and determine the residency as per the treaty. Then we'll move to the substantive provisions, basically the provisions related to allocation of right in case of a different category of income. We'll go to the relevant clause, see which country, which jurisdiction gets the right to tax and at what rate. We'll apply the particular substantive provision. So, for example, there is a payment as to royalty. We understand that suppose an Indian company is making payment to a company in US taxes it based on the residency principle, India taxes it based on the source principle. Now we will see the articles or provisions related to elimination of double taxation. We'll see generally Article 23 or 25 deals with that, which country will tax at what rate and which country will give credit, and that is how we follow the treaty provisions to the domestic law. And once a treaty is applicable and is beneficial in comparison to the provisions of the Act, then the treaty relief can be claimed as per Section 90. And then Section 90 prescribes certain documents. Unless those documents are obtained, one cannot claim the treaty benefit. So, what are those documents? First is tax residency certificate. So, when we are applying a treaty, we must know whether the corresponding party is resident of that particular state or no. Sitting here, one cannot determine whether a person is resident as per the domestic laws of that particular country. So, we rely on the tax residency certificate issued by the authorities of that particular jurisdiction. Section 90, subsection 4 also mandate that a treaty benefit cannot be claimed unless a tax residency certificate is available. There is a judicial controversy to this aspect also, which I've covered in the next slide. Other than TRC, Section 90, subsection 4 also provides that in addition to the TRC, there are certain documents which are prescribed has to be obtained. The the information prescribed has to be obtained. The information is to be obtained in Form 10F. So if TRC does not contain the specified particulars, then only we will have to obtain Form 10F. So whenever we issue a 15 CB or we make a PIM as a consultant, when we issue a certificate for deduction of tax at source, or as a matter of fact, we are tax. There's a particular assessee who wants to understand what would be the tax implication on a payment to a non-resident. So treaty provisions are applicable, but if the person to whom payment is to be made cannot provide TRC or Form 10F, treaty benefits cannot be given. Then these are the two documents which are given in the section itself in the provisions of law. Then there are certain recommendatory documents which are not prescribed, but it is recommended that those documents has to be taken. First is declaration stating no pay. So for income, passive incomes like royalty, FTS, interest, the treaty provision says that the articles relating to those passive income would be applicable if uh, the income is not related or connected to a permanent establishment. Also, for any not only royalty income, suppose I am making a payment which is a business income for the payee. He, if he do not have a permanent establishment in India, then the income is not taxable because Article 7 states that only the income which is attributable to a permanent establishment is taxed. So if there's no permanent establishment, then there is no taxability. But if there is a permanent establishment, then there is a taxability. So it is very important when we give a payment to a non-resident, we have to take a declaration from the payee that whether he has a permanent establishment here or no. Otherwise, how would consultant or the payer would know whether the payee has a permanent establishment or not? So this is a document which has to be obtained when for claiming the treaty benefit. Other is MLI declaration. So as we understand and as explained by Asim sir, now we have this multilateral instruments. Multilateral instruments MLI is now has to be read along with the treaty. So if I need to apply a treaty, I have to read MLI provisions into it, and then only I can grant the treaty benefit. MLI provisions contain certain treaty abuse provisions like principal purpose test. So one of the provision of MLI says that if the main purpose of any transaction is to obtain a treaty benefit, if the principal purpose is to obtain a tax benefit, the benefit shall be denied. Similarly, there are another treaty abuse provisions in MLI like beneficial ownership. We will discuss, if time permits, about the changes in certain articles because of MLI. So it is again necessary to obtain a declaration whether the principal purpose test is here or no. It's whether the condition as to the principal purpose test is satisfied. The payee gives a declaration that the principal purpose is not obtaining tax benefit, because payer cannot determine whether what is the principal purpose of the pay. But the MLI says that if the principal purpose is to obtain a tax benefit, then treaty benefit is denied. So I'm not saying by just taking a declaration suffice the requirement. One has to do a due diligence while making a payment, but still it is recommendatory to obtain this declaration as well. So these are the documents which we would need to basically claim a treaty benefit. So I was talking about this judicial controversy of obtaining a tax residency certificate to take the treaty benefit. The issue is Section 90, Section 2 permits that an assessee can take the treaty benefit if it is beneficial to them. 90 subsection 4 says that TRC is a mandatory document. So there is a view that till the time we obtain a TRC, treaty benefit will not be given. So the countries like UAE, there are sometimes a difficulty in getting tax residency certificate. Sometimes the taxable period is different, and TRC is generally given at the end of the taxable period. So whether at a given point of time, if I don't have a TRC for that particular taxable period, should I give that treaty benefit or no? So these few tribunal decision gives relief. They say that Section 90 subsection 4 does not override Section 90 subsection 2. So Ahmedabad, Hyderabad ITAT, they've held that treaty benefit cannot be denied merely because TRC is not available. So this particular interpretation is also subject to litigation, but I have referred it for the purpose of, I mean, to educate the listeners that these decisions are available to enable a person to take the TT relief even if the TRC is not there. So this is all I have covered to explain the basic concept of DTAA. And since we have time, I will touch upon this multilateral instrument. So multilateral instrument is basically a byproduct of web section plan. What is web section plan? So BEPS, the full form is base erosion and profit shifting. So in spite of all these double taxation avoidance treaties, jurisprudence, model commentaries, interpretations of international law, still because of this globalization, digitization, there were many situations wherein there was base erosion and there was a profit shifting to avoid the taxation. So, to implement treaty-related BEPS measure, to eliminate need for bilateral negotiations again and again, and to have a single instrument to deal with the situations of base erosion and profit shifting, there was this concept of MLI, which was being introduced by BEPS Section Plan 15. So there was a committee which was formed, G20 Summit, which launches BEPS project somewhere in 2012. Then there was a report which addresses the concerns of BEPS, and OECD submitted this BEPS section plan to G20. We have 15 BEPS section plans. Then there was an interim report in various action plans, including MLI. MLI is through Action Plan 15. Then there was a mandate to go to develop this MLI because everybody felt that this single instrument can help in uh, reducing the base erosion and profit shifting. So there was mandate given to this group for developing this MLI, and there was a launch of final BEPS project report with 15 action plans in 2015. MLI text and explanatory statement was adopted in 2016, and there was this historic day, 7 June 2017, when 68 countries, including India, signed MLI. So MLI कब से इफेक्टिव होता है, whether it is effective from signing or some other day. So as we discussed in DTAA, when a particular document or a treaty, be it bilateral or multilateral, is signed, then there is a ratification that happens at the jurisdiction level based on their domestic law. So when these countries do that ratification and deposit that instrument, then the date of entry into force and the entry into effect is determined. India deposited this document of ratification on 25th June 2019. So entry into force is generally, not generally, it is defined as 3 calendar months from the date of deposit of instrument of ratification. So India, since deposited the instrument of ratification on 25th of June 2019, the entry into force, the date of entry into force would be 3 calendar months, which would be July, August, September. So 1st of October 2019 is the date when it is said that the MLI has entered into force for India. So this date would be different for different countries. So if we have to look at any transaction, whether the MLI is to be read along with the treaty or no, we'll have to check. Unlike DTA, which almost all of us know that are applicable, barring this Hong Kong DTA, which is entered into few years back, all other DTAs are already into effect, and we usually apply it without seeing entry into force or entry into effect. But for MLI, we'll have to actually check whether a transaction with the other country is covered under MLI, whether the agreement with the other country is covered under MLI. So, how we check whether the MLI provision is applicable or to be read along with the treaty? Whenever we see a transaction, we'll have to see whether both the jurisdiction are signatory to MLI or no. So I have a transaction with some other country. If both the countries, whether both the countries have signed MLI or no. So all this literature or the text is available on the OECD website. One has to go there and see whether both the jurisdiction has signed to MLI or no. If they are signed, but suppose they have deposited instrument of ratification or no. So, for example, Indonesia deposited its uh, instrument of ratification on 28th April 2000. So, even if entry into force for India was 1st of October 2019, but for any transaction with Indonesia, till the time the other country deposit the instrument of ratification, the MLI provisions will not be applicable. So the second check is whether both the jurisdiction, even though signed the document of MLI, have also deposited instrument of ratification. Suppose both the countries have deposited the instrument of ratification, still we'll have to see. So in instrument of ratification, if you will open and see the instrument of ratification in the beginning of the document, they have given the covered tax agreements. So the all the agreements which would be covered, so so if we see India's instrument of ratification, so out of all treaties, tax treaties, what all treaties India wants to cover under MLI, they have mentioned the name of all the treaties. So, for example, India-China treaty is not covered. So MLI provisions will not be applicable or to be read when we look at India-China treaty. So third check is whether the treaty has been notified as CTA by both the jurisdiction or no. Once this is determined, then we'll have to see what is the entry into force and entry into effect. And provisions of MLI will be applicable only when there is an entry into effect. So entry into force is basically determines the entry into effect, and the provision gets applicable only when there is an entry into effect. So, for example, India deposited its instrument of ratification on 25th of June 2019. And as I just mentioned, Indonesia deposited it on 28th of April 2000. So, entry into force would be on the expiry of 3 calendar months from the date of deposit of instrument of ratification. So in case of India, it was 1st of October 2019, and in case of Indonesia, since the date of deposit is 28th of April, so May, June, July. 1st of August 2020 would be the date of entry into force. And what is entry into effect? So for withholding tax purposes, I have to see if I am making a payment from India to Indonesia, I have to see whether for withholding taxes, whether the date of entry into effect has came or no. So, what is the date of entry into effect? That is determined on the basis of later of the dates of entry into force. So that is how the date of entry into force is material. So for India, it was 1st of October 2019. For Indonesia, it was 1st of August 2020. So later of the two is 1st of August 2020. So entry into effect for India would be next financial year. Basically, the law says taxable period. So for India, it's financial year. So financial year immediately after the later of the date of entry into force, which will be 1st of April 2021. But for Indonesia, since it follows calendar year, it is 1st of January 2021. Now, what does that mean? That means if a person who is resident in India has to make a payment to a person who is resident of Indonesia, the MLI provisions has to be read along with the tax treaty with effect from 1st of April 2021. However, if a person who is a resident of Indonesia has to make a payment to a person who is resident in India, the provisions of MLI will read into the provisions of tax treaty with effect from 1st of January 2021. So one has to be very particular of these dates while applying the provisions of MLI. This is the broad structure of MLI instrument. So part 1, Article 1 and 2 as in the DTAs deals with the scope of the MLI document and the definition of certain terms. Article 3 to 5 deals with hybrid mismatches. When we say hybrid mismatches, so the situations concerning the transparent entities, the dual residency, or the elimination of double taxation. And as I mentioned, MLI includes the provisions which relates to treaty abuse. Article 6 to 11. It's a very, very important articles which are to be read, referred while applying any treaty provision. Article 6 emphasize on the purpose of the covered tax agreement. So, what is the purpose of the covered tax agreement? And MLI says the purpose is not to obtain a treaty, so to eliminate the treaty shopping. Article 7, very, very important, which deals with this principal purpose test. And the principal purpose of doing a transaction is not to obtain the tax benefit. So one has to demonstrate that the purpose, rather than the tax benefit, maybe any business rationale or any other factor based on which that transaction is happening, not the principal purpose is not obtaining the tax benefit. It also contains provisions related to limitation of benefit, which is already there in few of the treaties, but by way of this MLI provisions, those LOB and SLOB provisions are being introduced in the treaty. So if there is a transaction between two jurisdiction, one has to see if the provisions of so article 7 gives the option either to resort to PPT or to LOB. So if particular jurisdiction has resorted to LOB, one has to see whether those LOB provisions conditions are fulfilled before giving the treaty benefit. India has initially agreed for this principal purpose test. Later on, they may add the specific LOB provisions also. Article 8 is very interesting. It relates to dividend. So we have this article in our treaty provisions wherein the right to tax at a lower rate is given to source state, and many of the treaties we have condition that this restricted or the lower rate or the treaty benefit can be obtained if a person beneficially owns a certain percentage of shares. So to obtain a treaty benefit, uh, what one used to do was to buy the shares and uh, maintain the condition of that specific percentage threshold as defined in the treaty and obtain the treaty benefit. Now, this MLI provision says that this wherever there is this percentage thresholding required, that has to be there for 365 days. So we have few treaties wherein we have number of days threshold also. There is only one or two treaties, but by way of MLI, this concept of percentage holding for a number of days is being introduced, and if it's not there, the benefit of lower rate as given in the treaty for the purpose of dividend income shall be denied. So these are the treaty abuse provisions. Similarly, we have uh, capital gain provisions wherein a lower rate is given provided there is a holding for a particular uh, percentage of shares. Again, number of days of holding has been introduced. Then we have other anti-abuse provisions in Article 6 to 11. Article 12 to 15 deals with avoidance of permanent establishment status. So we have this clause related to permanent establishment in DTA, and once permanent establishment exposure is there, the any profit which is attributable to that permanent establishment gets taxed. So what the entities try to do is to avoid this permanent establishment status. So the provisions of MLI have tried to introduce provisions to avoid to basically deny the benefit of treaty, or to maybe tax that permanent establishment if they just avoid their permanent establishment exposure through maybe fragmentation of the contracts or any other artificial method to avoid the permanent establishment. Then we have Articles 16 and 17 dealing with the dispute resolution and other miscellaneous articles related to arbitration and other provisions related to entry into force, entry into effect, termination, etc. So this is the broad structure of MLI instrument, how MLI is applied, and what is the importance of MLI. So going forward, once all the countries will sign MLI, deposit their instrument of ratification for all the covered tax agreements. So when we give benefit of a treaty provision, we'll have to actually read those MLI provisions along with the treaty provision. If we don't do that, then there will be not correct interpretation of law, and we might end up doing a wrong interpretation if we ignore MLI. So this is all about today's presentation. With regard to MLI, I would like to add one more thing. If you go to income tax website, you will see earlier there used to be limited and comprehensive agreements which were reflected under the tax treaties. Now we have synthesized tax. So what is synthesized tax? So in though it's not a formal document, but what the countries have done is that wherever MLI provision has an effect on the existing tax treaty, they have inserted that particular provision along with that particular para of the existing tax treaty so that one can read it comprehensively. So these are the synthesized texts one can refer to instead of reading tax treaties and MLIs separately, one can read it together. So this is all about today's presentation. I am open. The floor is open for questions. I'll be answering or maybe request the Seam sir to answer the questions which are being asked by the listeners. Thank you. Thank you for giving me this opportunity, and thank you for the patient hearing.
So, ma'am, we have a few questions in our comment box. So, the first one is from Sharad Saxena. He is asking if payment made to America and TRC received from Singapore, then Singapore DTA benefit can be obtained. If not, please explain.
So transaction is what I understand from your query is that an Indian entity is making payment to an entity which is resident of Singapore, correct? And we are making a payment to America. What does that mean? To the bank account in America? So if I'm making a payment as an Indian, I'm making a payment to a person who is a resident of Singapore. That's how he's obtained the certificate of residency from Singapore. So the resident state is Singapore, so state is India. So India Singapore treaty will be applicable. Does that answer your question?
Okay. Ma'am, I think
Bhavya, do we have a system of? I mean, can the listeners also discuss their query, or only the chat option is there?
Ma'am, only chat option is there.
Okay.
So, this is the only query we have. So, I again request all the viewers, if you have any query, so you can still write it down in the comment box.
So, Mavya, we don't have any further query. Um, if Asim sir's permit, we can close the session for today.
Okay, ma'am, there is no further queries in the comment box, so I just give the vote of thanks and just wind up the session. So, thank you, Parul ma'am, for such a wonderful presentation, and thank you, CS Seem Chawla ji, for being a session chairman of this webinar. And thank you, all the viewers, for your patient hearing. And the next session will be on coming Saturday, that is 2nd October, and the topic of webinar will be transfer pricing. And the timing of next webinar is 4 to 6 p.m. as usual. Thank you so much.
Thank you, Mavya. Thanks all the listeners.